Picture this, late 2026. The US Treasury needs to sell another $200 billion in bonds this week. Nothing dramatic happened. No war, no pandemic, no Lehman moment. But the auction feels thin. Foreign central banks used to line up for this paper. Japan, China, Europe, the oil exporters. Now they're buying less, rolling over less, quietly diversifying into gold. The Federal Reserve used to be the buyer of last resort. Now it's running down its balance sheet instead of expanding it. Quantitative easing became quantitative tightening. American banks used to absorb treasuries as risk-free assets. Now tighter capital rules and ugly mark-to-market losses have made them gun-shy. Silicon Valley Bank taught everyone what happens when your safe assets lose 20% of their value overnight. And at exactly the same time, the US government's borrowing needs are exploding. Deficits north of $1.8 trillion. A mountain of old debt rolling over at higher interest rates. The interest bill alone now exceeds $1 trillion per year, larger than the entire defense budget. So here's the question. Nobody in Washington wants to answer. When everyone is stepping back from the table, who is left to buy? The answer is hiding in plain sight. It's not a central bank. It's not a pension fund. It's not a sovereign wealth fund. It's an app on your phone. 1. The buyer problem. Why nobody wants American debt anymore? Let's start with the math, because the math is brutal. The United States borrowed $1.8 trillion in fiscal year 2025. In the first 2 months of fiscal year 2026, the government borrowed another $439 billion. That's $7 billion per day. The Congressional Budget Office projects deficits approaching $2 trillion annually through the end of the decade. That's not a crisis. That's the baseline. That's the best case scenario, assuming nothing goes wrong. And the interest bill? Net interest payments on federal debt surpassed $1 trillion for the first time in 2025. By 2035, CBO projects that number hits $1.8 trillion annually. The government now spends more on interest than on national defense, more on interest than on Medicare. Interest is the fastest growing line item in the federal budget. Debt held by the public equals 100% of GDP today. By 2035, it reaches 118%, higher than at any point in American history, including World War II. Someone has to buy this debt. Someone has to absorb $2 trillion in new treasuries every year. Someone has to roll over the mountain of existing debt maturing at higher interest rates. Now ask, who? Historically, there were 4 major categories of treasury buyers. All 4 are stepping back. First, foreign governments. Japan holds over $1.13 trillion in US treasuries, down $32.6 billion from its 2024 peak. China holds $757 billion, down from over $1 trillion in 2021. $250 billion has quietly left China's treasury portfolio in 4 years. Together with other foreign central banks, they own about 30% of outstanding treasury debt. But that share has been declining for 15 years. At its peak during the financial crisis, foreign investors held over 50%. Why are they leaving? De-dollarization. Central banks are diversifying into gold. Russia and Iran are settling trade in non-dollar currencies. Even US allies are hedging their bets. Second, the Federal Reserve. During quantitative easing, the Fed was buying $80 billion in treasuries per month after month after month. They accumulated trillions in government bonds on their balance sheet. Now they're in quantitative tightening mode, letting bonds mature off the balance sheet at a rate of $25 billion per month. They're not buying, they're shrinking. Third, American banks. They used to park excess reserves in treasuries as the ultimate safe asset. Then 2022-2023 happened. The Fed raised rates at the fastest pace in 40 years. Bond prices collapsed. Banks holding treasuries took massive unrealized losses. Silicon Valley Bank failed because it couldn't sell its treasuries without crystallizing losses that wiped out its capital. Signature Bank, First Republic. The contagion spread. Now banks are gun-shy. Regulatory capital rules under Basel III make holding long-duration bonds expensive. Bank treasury holdings are growing slower than the supply of new debt. Fourth, American households and pension funds. They buy some, but nowhere near enough to fill the gap left by foreigners, the Fed, and cautious banks. J.P. Morgan Research estimates that each 1 percentage point decline in foreign holdings relative to GDP, roughly $300 billion of treasuries, would push yields up by more than 33 basis points. In plain English, if foreigners stop buying, interest rates spike. If interest rates spike, the deficit gets worse. If the deficit gets worse, the government needs to sell more bonds. If they sell more bonds with fewer buyers, rates spike again. That's not a problem. That's a doom loop. 2. The Genius Act, the legislation nobody understood. In July 2025, President Trump signed the Genius Act into law. Genius stands for Guiding and Establishing National Innovation for U.S. Stablecoins. It passed the Senate 68 to 30. It passed the House 308 to 122, bipartisan majorities. The media covered it as crypto regulation, bringing stablecoins under federal oversight, consumer protection, money laundering prevention, boring compliance stuff. They missed the point entirely. Here's what the Genius Act actually does. Every stablecoin issuer in the United States must now maintain reserves backing their tokens on a one-to-one basis. For every dollar of stablecoin in circulation, there must be $1 in reserves. And here's the key. Those reserves can only be held in a specific list of assets: US dollars, cash deposits at insured banks, and most importantly, short-term US Treasury bills. Not corporate bonds, not foreign government debt, not mortgage-backed securities, not Bitcoin. Treasuries. The Genius Act doesn't just regulate stablecoins, it conscripts them into the Treasury market. Every stablecoin minted under this framework requires a Treasury bill to back it. Every dollar of growth in the stablecoin market creates automatic, mandatory demand for US government debt. This isn't deregulation, it's not even regulation. It's a new class of forced buyers for American debt built into the architecture of crypto itself. Let me know in the comments, did you catch this when the Genius Act passed, or did it fly under your radar? 3. The Tether empire. How a crypto company became a top 20 treasury holder. To understand what's coming, look at what's already here. Tether, the company behind USDT, the world's largest stablecoin, just released its Q4 2025 attestation. The numbers are staggering. Total USDT in circulation, $186 billion. That's larger than the GDP of most countries, larger than the entire monetary base of many emerging markets. USDT grew by $50 billion in 2025 alone, one of the fastest annual expansions of a dollar-denominated financial instrument ever recorded. Tether's user base, over 530 million people globally, and that's larger than the entire population of the European Union, larger than the United States, 500 million people holding digital dollars. Tether is on track to profit over $10 billion in 2025, with roughly 150 employees. That's $67 million per employee, making Tether one of the most profitable companies on earth relative to headcount. They're on pace to make more profit than most banks, with a fraction of the staff. How? By earning interest on their reserves. And here's the number that matters. $141 billion in US Treasury exposure, $122 billion in direct Treasury holdings, another $19 billion in overnight reverse repurchase agreements backed by Treasuries. Total exposure, $141 billion. That makes Tether one of the largest holders of American government debt on the planet. Larger than the central banks of most nations, larger than South Korea's entire Treasury portfolio. If Tether were a country, it would rank around 17th among foreign holders of US debt. They passed South Korea. They're approaching Germany. And Tether holds 78% of its reserves in Treasuries. Not 50%, not 60%, 78%. They didn't do this because regulators forced them. They did it because short-term Treasuries pay 4 to 5% yield with zero credit risk. Free money. Circle, the company behind USDC, the second largest stablecoin, is even more conservative. 88% of USDC reserves are in Treasury bills with an average duration of just 12 days. That's another $30 billion or more in Treasury demand. Combined, the two largest stablecoin issuers hold more US government debt than the central banks of Russia, India, or Brazil, more than all but a handful of sovereign nations. Now imagine what happens when the Genius Act forces every stablecoin issuer to follow this model. 4. The growth trajectory, where $2 trillion in new buyers comes from. The stablecoin market today sits at roughly $300 billion. Standard Chartered projects, the market will reach $2 trillion by the end of 2028. City projects, $1.9 trillion by 2030 in their base case, up to $4 trillion in a bullish scenario. Even the U.S. Treasury Borrowing Advisory Committee is using the $2 trillion figure in their own projections. J.P. Morgan is more skeptical. They project $500 to $600 billion by 2028. But even that conservative estimate implies $200 to $300 billion in additional Treasury demand. Let's use the Standard Chartered number. If stablecoins grow from $300 billion to $2 trillion by 2028, that's $1.7 trillion in additional reserve assets required. Under the Genius Act framework, most of those reserves will be held in short-term treasuries. Jeff Kendrick, Standard Chartered's head of digital assets research, put it bluntly, for stablecoins to inflate from $230 billion to $2 trillion by 2028, we would require an additional $1.6 trillion in US T-bills to be held as reserves. This would be enough to absorb all the fresh T-bill issuance planned for the rest of Trump's second term. Read that again. Stablecoin reserves could absorb the entire net new supply of Treasury bills for the next 4 years. The demand problem isn't just getting solved, it's getting reversed. 5. The de-dollarization paradox. Why the dollar's enemies are funding its survival. For years, the financial media has been obsessed with de-dollarization. BRICS countries settling trade in local currencies. Central banks dumping treasuries and buying gold at record pace. Russia and China building alternative payment systems. Saudi Arabia flirting with yuan-denominated oil contracts. The narrative screams, the dollar is dying. American hegemony is ending. The empire is crumbling. And some of it is true. Foreign central bank holdings of treasuries have declined as a share of the total, from 50% at the peak to 30% today. The dollar's share of global reserves has dropped from 70% to around 58% over 2 decades. Gold buying by central banks hit multi-decade highs in 2023 and 2024. J.P. Morgan called early 2025 a sell America moment, a rare trifecta where U.S. stocks fell, Treasury yields rose, and the dollar weakened simultaneously. That combination has only happened 13 times since 1970. It signals eroding confidence at the sovereign level. But here's what the de-dollarization narrative misses entirely. While governments move away from the dollar, people are sprinting toward it, frantically, desperately, by the hundreds of millions. In Turkey, where inflation hit 65% in 2024 and the lira has lost 80% of its value since 2018, stablecoin purchases equal 3.7% of GDP annually, not 0.1%, not 0.5%, 3.7% of the entire Turkish economy spent buying digital dollars. Turkish citizens processed over $63 billion in cross-border stablecoin payments in 2024 alone. That's more than many countries' entire trade volumes. In Argentina, where inflation topped 200% in 2023 and the peso lost 90% of its value over a decade, over 60% of crypto users regularly convert their local currency into stablecoins. They're not speculating on Bitcoin. They're not chasing meme coins. They're fleeing their own money. President Milei devalued the peso by 50% in a single day in December 2023. Stablecoin adoption accelerated. In Nigeria, where currency controls and FX shortages make dollars almost impossible to access legally, USDT volumes on peer-to-peer markets exceed official banking channels. Nigeria has 54 million crypto users and 26 million stablecoin users, a penetration rate of nearly 12% of the entire population. For reference, only 26% of American adults have ever owned any cryptocurrency. Brazil, Indonesia, Vietnam, India, Pakistan, the Philippines, Venezuela. Across the developing world, stablecoin adoption is surging. Standard Chartered estimates that 2/3 of current stablecoin demand originates in emerging markets. People in developing countries pay a stablecoin premium, on average 4.7% above the official dollar price. In Argentina during currency crises, that premium reaches 30%. They're paying extra for the privilege of holding digital dollars. Think about what's actually happening. Every USDT in a Turkish wallet requires a treasury bill in Tether's vault. Every Nigerian buying stablecoins to protect their savings from naira devaluation is, unknowingly, funding American government debt. Every Argentine fleeing the peso is backstopping the U.S. fiscal deficit. De-dollarization at the government level, re-dollarization at the street level. And the street level has 530 million users. The street level is winning. 6. The digital Eurodollar. How crypto became the dollar's distribution network. After World War II, dollars accumulated outside the United States, in European banks, in offshore accounts, and the pockets of global trade. These were called Eurodollars. They weren't controlled by the Fed. They weren't subject to U.S. banking regulations, but they were still dollars, and they extended American monetary influence into every corner of the global economy. The Eurodollar system helped cement the dollar as the world's reserve currency. Dollars circulating offshore created demand for dollar assets. Foreign banks holding dollars needed somewhere safe to park them. U.S. Treasuries were the obvious choice. Stablecoins are the Eurodollar system for the digital age, except faster, bigger, more decentralized, and harder to regulate away. A saver in Lagos can hold USDT on their phone without ever touching a U.S. bank. A merchant in Istanbul can accept payment in USDC without a correspondent banking relationship. A small business in Buenos Aires can pay suppliers in digital dollars while their government imposes capital controls. None of this requires permission from local central banks. None of it flows through SWIFT. None of it shows up in traditional banking statistics until it's already happened. The numbers are staggering. In 2024, stablecoin transaction volume exceeded $4 trillion. Circle's USDC alone facilitated $18.3 trillion in annual transactions. Tether's USDT processed $13.3 trillion. Monthly volumes exceeded $700 billion by late 2025, with September 2025 hitting $1.25 trillion in a single month. This volume has decoupled from crypto trading cycles. When Bitcoin pumps, trading spikes. But stablecoin volumes climb steadily regardless of market sentiment. indicating product market fit outside speculation. Businesses are solving real problems: settlement delays, FX costs, capital trapped in transit. Morgan Stanley reports that stablecoins are now used heavily for cross-border payments and remittances across emerging markets. Sending $200 through traditional remittance channels to sub-Saharan Africa costs an average of 8.3% in fees. Sending the same amount via stablecoin costs less than 0.1%, a 98% reduction in costs. That's not a small improvement. That's an order of magnitude. In Africa and Latin America, USDT on the Tron blockchain accounts for 85% of stablecoin payment volume due to low fees and wide acceptance. Stablecoins enable 24/7, 365 liquidity management. Treasury managers can rebalance globally on weekends. Cross-border intercompany transfers that took 3 to 5 business days and cost thousands in wire fees now settle in under an hour for a few dollars. The technology that was supposed to disrupt the dollar has become its most efficient distribution network. Every stablecoin is a digital dollar. Every digital dollar is backed by Treasury debt. The crypto revolution didn't kill the dollar. It put the dollar in every smartphone on Earth. Quick poll. If you lived in a country with 100% annual inflation, would you convert your savings to stablecoins? Tell me in the comments. 7. The trap tightens. Why this can't be reversed. Here's where it gets interesting. Once stablecoin issuers hold trillions in treasuries, they become systemically important, too big to fail, too integrated to remove. Think about the incentives. The US government needs buyers for its debt. Stablecoin issuers need safe, liquid assets for reserves. The Genius Act creates a marriage of convenience that benefits both parties. Tether earns roughly 4 to 5% annually on its treasury holdings. With $141 billion in exposure, that's $5 to $7 billion per year in risk-free interest income. That's why Tether is on track to profit $10 billion in 2025. They don't need transaction fees. They don't need trading revenue. They just need to hold treasuries and earn the spread. The bigger the stablecoin market gets, the more treasuries they must hold. The more treasuries they hold, the more profit they make. The more profit they make, the more capital they have to expand. It's a self-reinforcing cycle, and it's a cycle that serves American interests. Professor Barry Eichengreen of UC Berkeley noted that if panicked customers force stablecoin issuers to sell their treasury holdings, prices could collapse and interest rates could spike. The implication? Once stablecoins hold enough treasuries, they become too important to the bond market to be allowed to fail. The Federal Reserve backstops the banks. Soon, it may need to backstop the stablecoin issuers too. 8. The global trap. How the US is exporting dollar dependency through apps. The Genius Act has extraterritorial provisions, and these provisions are the key to understanding how the system locks in the rest of the world. Foreign stablecoin issuers can only operate in the United States if they register with the Office of the Comptroller of the Currency, hold reserves at U.S. financial institutions, and comply with U.S. lawful orders, including asset freezes, seizures, and sanctions directives. In other words, if you want to issue dollar stablecoins and have them trade on American exchanges or be used by American citizens, you play by American rules. Period. This isn't financial regulation. This is jurisdiction expansion. The U.S. is extending its regulatory reach to every stablecoin issuer on Earth that wants access to the dollar system. And they all want access, because the dollar stablecoin market is where the users are, where the liquidity is, where the profits are. The EU is worried. Italy's economy minister warned that U.S. stablecoin policy poses a greater threat to European sovereignty than trade tariffs. Let that sink in. A European finance minister is saying crypto regulation is more dangerous than a trade war. The European Central Bank published a financial stability review, noting that stablecoin issuers now rank among the largest holders of U.S. Treasury bills, with reserve assets comparable to the top 20 largest money market funds. They see what's happening. American crypto regulation is creating a massive pipeline of forced Treasury demand, and Europe has no equivalent. Asia is scrambling to respond. Hong Kong passed its stablecoin ordinance in May 2025, requiring licenses for Hong Kong dollar-backed stablecoins. But who wants Hong Kong dollar stablecoins when USD stablecoins are universally accepted? Standard Chartered estimates that emerging market banks could lose $1 trillion in deposits as savers migrate from low-yielding domestic accounts to dollar-denominated stablecoins backed by U.S. Treasuries. $1 trillion. Hemorrhaging from EM banking systems into American debt markets. For EM regulators, this resembles a persistent run. Liquidity reallocation into offshore dollar instruments that fall completely outside their supervisory perimeter. They can't stop it. They can barely track it. The United States didn't invade these countries. It didn't impose sanctions. It didn't negotiate trade deals. It didn't send aircraft carriers. It just built a better app. And the app comes with Treasury demand baked into its architecture. 9. The Canada-China question. Where this leaves middle powers. So where does this leave a country like Canada, caught between two systems, On one side, the United States, weaponizing financial technology to extend dollar hegemony. The Genius Act framework, stablecoin regulation that pulls capital toward American debt markets. A monetary architecture that rewards dollar loyalty. On the other side, China building alternative payment rails, the digital yuan, BRICS settlement systems, bilateral currency agreements that bypass the dollar entirely. Canada trades 76% of its exports to the United States. Canadian pension funds hold more assets in U.S. markets than in Canadian markets. The Bank of Canada can't set interest rates more than about 250 basis points from the Federal Reserve without crashing the loonie. Canada is already economically integrated with the United States. The stablecoin revolution just makes that integration tighter. But here's the uncomfortable question. If Canadian citizens start holding USD stablecoins instead of Canadian bank deposits, and some already are, what happens to Canadian monetary sovereignty? If Canadian businesses settle cross-border payments in USDC instead of through Canadian banks, what happens to the domestic financial system? If the next generation of Canadians grows up using dollar-denominated digital wallets, what happens to the demand for the Canadian dollar? The same dynamics playing out in Turkey and Argentina and Nigeria could eventually play out in Canada, not because Canada has 200% inflation, but because digital dollarization doesn't require a crisis, it just requires convenience. The pipes are already being built. 10. The irony. Why the dollar's biggest threat became its biggest ally. Here's the supreme irony of the 2020s. Bitcoin was supposed to end the dollar. Decentralization, sound money, freedom from central bank manipulation. That was the promise. What actually happened? The crypto ecosystem became obsessed with stablecoins, tokens pegged to the US dollar. The entire DeFi universe runs on dollar-denominated liquidity. Over 99% of stablecoin market cap is pegged to the USD. Crypto didn't create an alternative to the dollar. It created the world's most efficient dollar distribution system. And now, with the Genius Act, the distribution system comes with mandatory Treasury demand built in. Every time a Nigerian downloads a wallet app and converts Naira to USDT, they're funding American debt. Every time an Argentine saver buys stablecoins to escape peso depreciation, they're supporting US bond markets. Every time a Turkish merchant accepts USDC to avoid lira volatility, they're backstopping the American fiscal deficit. The revolution was co-opted. The rebellion was absorbed. The technology that promised to overthrow the financial system now props it up. I told you about the global dollar trap in my video on why Canada can't quit the USA. This is the same trap, but now it's running on blockchain rails. What do you think? Did crypto kill the dollar or save it? Tell me in the comments. 11. The risk. What could go wrong? This system is not without risks, and the risks are significant. Risk 1, concentration. 99% of Tether's treasury holdings are custodied through a single firm, Cantor Fitzgerald. That's $140 billion flowing through one counterparty. Any disruption at Cantor, a scandal, a bankruptcy, a regulatory action, could cascade through the stablecoin market and into treasury markets themselves. Single points of failure at this scale are terrifying. Risk 2, regulatory arbitrage. Tether is registered in El Salvador, not the United States. It operates largely outside U.S. prudential oversight. The Genius Act creates a framework for compliant U.S.-regulated stablecoins, but Tether may continue operating offshore, serving non-U.S. users with less stringent requirements. A two-tier market could emerge, regulated stablecoins for Americans, unregulated stablecoins for everyone else. The Treasury demand benefit only applies to compliant issuers. Risk 3, a run. Stablecoins can be redeemed on demand. Unlike bank deposits, there's no friction, no delay, no questions asked. If users lose confidence and try to redeem simultaneously, like they did briefly when Silicon Valley Bank collapsed and Circle had reserves there, issuers would need to sell treasuries rapidly. Fire sales could destabilize bond markets. The very mechanism that provides steady demand could become a source of sudden, violent supply. The 2022 Terra USD collapse showed how fast algorithmic stablecoins can unravel. Fiat-backed stablecoins are more stable, but they're not immune to panic. Risk 4, political interference. What happens when the US government decides to freeze someone's stablecoins? The Genius Act requires issuers to comply with lawful orders, including asset freezes and sanctions. That means every USDT and USDC holder is subject to American financial jurisdiction, whether they know it or not. This is a feature for the US government. It's a bug for users who thought they were escaping government control. Risk 5, competition. The digital euro is in development. The digital yuan is operational. Other CBDCs are coming. If major economies launch central bank digital currencies that offer similar convenience with state backing, stablecoin demand could plateau or decline. Governments may actively suppress private stablecoins to promote their own CBDCs. But here's the thing about all these risks. They all reinforce the same conclusion. The United States has powerful incentives to ensure stablecoin markets don't fail, to ensure Tether doesn't collapse, to ensure the Treasury demand machine keeps running. The bigger stablecoins get, the more systemically important they become. The more systemically important they become, the more the US government will protect them. That's not a bug, that's the design. 12. The verdict. What this means for you. So what does this mean for an ordinary person watching this video? If you're American, your government has found a new source of demand for its debt. That doesn't fix the deficit. You're still running $2 trillion shortfalls with no end in sight. But it buys time. It prevents the bond market crisis that would force immediate, painful austerity. It kicks the can down the road another decade. The Genius Act is a pressure release valve for the most indebted government in human history. But understand the trade-off. The US is now financially intertwined with an industry it spent years treating as a threat. Crypto isn't going away. It can't go away. It's now systemically important to Treasury markets. If you're in an emerging market, dollar stablecoins will continue eating into your local banking system. Your currency will face persistent depreciation pressure as citizens convert savings into digital dollars. Your central bank will lose control over monetary policy as dollarization spreads through apps instead of physical cash. Holding stablecoins isn't just convenient, it's increasingly necessary for anyone who wants to preserve purchasing power in countries with unreliable currencies. But recognize what you're doing. You're funding American borrowing while your own government struggles to borrow. You're exporting your savings to prop up a foreign empire's fiscal deficit. If you're Canadian, watch this space carefully. The same dynamics reshaping finance in Turkey and Argentina and Nigeria will eventually reach your doorstep. Dollar stablecoins don't respect borders. The Bank of Canada can't stop Canadian citizens from downloading wallet apps and converting their savings into USDC. The question isn't whether digital dollarization comes to Canada. The question is how fast, and whether Canada develops any meaningful response or just gets absorbed into the American monetary system like everything else. If you're an investor, understand that Treasury demand is being structurally supported by forces outside traditional finance. Bond bears who expected a crisis may need to recalibrate their timelines. The buyer of last resort isn't the Fed anymore. It's the stablecoin industry. That changes the game. If you're in crypto, recognize the deal that was made. The industry begged for regulatory clarity for years. It got clarity, but clarity came at a price. Integration into the traditional financial system. Stablecoins are now a tool of dollar hegemony, not a challenge to it. The revolution was institutionalized for everyone. Understand that financial systems don't die from frontal attacks. They die from co-optation, from absorption, from being made obsolete by something that looks like disruption but is actually continuation. Crypto was supposed to be the disruption. Instead, it became the continuation. 13. The final truth. The dollar lives. Because it adapted. Let me leave you with this. Reserve currencies don't die from competition. They die from complacency. The British pound didn't collapse because the dollar was better. It collapsed because Britain stopped adapting after 2 world wars drained its treasury and credibility. The dollar in 2025 faced a real threat. Deficits spiraling, buyers retreating, interest costs exploding, de-dollarization headlines everywhere. And then, almost accidentally, the United States found a new class of mandatory buyers, hidden in the crypto revolution, enabled by legislation most people ignored. The Genius Act wasn't genius because of its design. It was genius because of its effect. It transformed a threat into a tributary system. It turned stablecoin issuers into bond buyers. It exported dollar demand through every smartphone app in the developing world. The technology that promised to end the dollar now funds the deficit. The people fleeing their currencies are fleeing into treasury-backed stablecoins. The system didn't break. It bent. It absorbed. It adapted. The question isn't whether the dollar survives. It will. The question is whether you understand the new architecture of that survival. Because the dollar isn't just backed by aircraft carriers anymore. It's backed by apps.